Hey there, it's Mike Langford. Welcome to another episode of the SoFin Podcast, part of the FinServ Marketing Podcast Network. This week on the show, I am joined by Gopi Rangan, the founding partner at Shore Ventures, a seed stage firm based in Silicon Valley. But as you'll hear Gopi mention during this show, while the Valley may be his home base, he invests in companies all over the country. In fact, Gopi invested in Rocket Dollar based here in my adopted hometown of Austin, Texas. And as you may remember, Henry Yoshida, the co-founder and CEO of Rocket Dollar, was on an earlier episode of this show. And he also joined me for an episode of the Modern Financial Advisor podcast that we produce for Trulytics. So if you're interested in learning more about Rocket Dollar, make sure you go check out those episodes. One quick note, Gopi and I recorded this episode a few months back. Nothing material has changed since we recorded the show, except for the fact that Gopi has published 23 episodes of his podcast, The Sure Shot Entrepreneur, instead of the 8 episodes you hear him mention. Anyway, I'm thrilled to be finally releasing this episode into the wild because, as you'll hear, he has a fantastic way about him, and his approach to investing in our space is really smart. So I think you're going to love this show. Before we get started, make sure you check out our newest podcast on the network, the InvestNet Yodelay Launchpad podcast, featuring Christine Laredo and Holly Weckler, and hosted by yours truly. It's an amazing show that taps into the expansive and influential ecosystem of thought leaders, innovators, and entrepreneurs that only a company like InvestNet Yodelay can amass. Also, make sure you swing by the Modern Financial Advisor podcast by Trulytics as well. We've had some really interesting guests recently. On the latest episode, Tom Hine, author of The Zen of Business Acquisitions, shares some great tips for staying calm and confident while buying a business. You can find all of our podcasts at finservmarketing.com/podcasts. Make sure you subscribe to each one of them to ensure that you stay plugged into all the cool stuff happening in our space. Okay, let's get to it with Gopi Rangan. All right, well, Gopi, man, I'm so excited to have you on the show, and we weathered the technical difficulties as people seem to do to make it happen. So I appreciate you sticking with it, and great to have you on the show.
I'm super excited. Thank you so much for inviting me. This is very exciting. I'm excited to be one of your first venture capital guests on the show.
Not one of the first, you are the first. So this is really exciting. And it's interesting, you know, in my travels here in the startup ecosystem, in the, fintech world, and the event that I host at South by, obviously big network of VCs and angels, and but you were the first one, and I'm glad Andrea put us together. So we're going to cover a lot of ground because you teed up a really interesting topic. So to set the stage for some people, you are an early investor in Rocket Dollar, and I just had Henry Yoshida, one of the founders of Rocket Dollar, on the show, and the topic you teed up is a really interesting one, right? In that there's a big move from public market investing, so stocks, bonds, mutual funds, but particularly on the equity side, to private market investing. And I thought that was a really cool idea. So let's dive into it. Like, why are individual investors, financial advisors, asset managers looking to private markets a little more than they have in the years past?
Yeah, certainly. The early stage investing sector is where I focus. A lot of my investments are primarily focused on pre-seed, seed stage startups, and I focus a lot on the insurtech sector. The
Mm-hmm.
mission with which I invest is to enable peace of mind. So any startup that helps create a better safety net or builds a better infrastructure for legacy industries like insurance, those are the startups that I invest in. Shore Ventures is one of the earliest investors in Rocket Dollar. Henry Yoshida is the CEO. I admire him and his team and how they're building the solution that will democratize access to uh, asset classes like venture capital and others that are typically not available through other platforms.
Mm-hmm.
They are enabling people to use their IRA, 401k accounts to invest in startups and real estate and various other things. Why there is a reason, the reason for people to move more and more into this asset class, the alternate assets in general, is that the public market is, I really cannot figure out what's really happening in the public market. Why does it go up and why does it go down? And
Yeah.
the number of stocks in that are publicly traded is cut in half in the past couple of decades. So the number of choices have reduced significantly, and no one really seems to have a good handle on how to even know uh, the value of the company that's publicly traded. Some of them are traded at significantly higher multiples than they should be. Some of them are significantly undervalued, and a lot of other macroeconomic factors seem to affect. But the once you figure out why it's working, a whole new thing comes in, and then that changes all the equations. So it's very difficult to generate consistent returns in the public market. So therefore, there's a lot of interest in alternate assets where people have better control over where their underlying assets are. So that's why it's interesting to look at, especially the venture capital sector. So if you look at some of the largest investors who focus on this sector, endowments and insurance companies, retirement funds, they have a significant portion of allocation. When I say significant, it used to be a couple of percentage points a few decades ago. It's now increased to 5%, 10%, 20%. Some of them are even looking at 30% and higher.
Very interesting. And it's fascinating to me because on the private side, things have changed quite a bit over the years, right? It used to be if you invested in an early stage company, the expectation was it was probably going to go public at some point in time, right? It was just kind of the way it was, especially when VC investing really started to take off in the 90s, right? But now, more often than not, companies are acquired. Like a startup will be acquired by another, maybe a public company, but it also could be another private company acquisition. So the kind of the dynamics have changed a lot as well.
Yeah, this asset class has evolved and matured. It's no longer one monolithic asset class. If you go back, dial the clock back to the earliest days of venture capital, the father of venture capital is George Dorio. He was a professor at Harvard, and then he later started a university, a business school called INSEAD, where I studied and I got my MBA later. He was one of the first investors in Digital Equipment Corporation.
Hmm.
He invested a modest, I don't know, $50,000 or $70,000, which turned into 20x in a short period of time. The company went IPO at $350 million. And his principles still remain the same. Like, you invest in companies without expecting short-term returns. You're investing for the long term. You're actively involved in helping the companies grow in various different ways that you can contribute, whether with recruiting, whether with future fundraising, whether finding customers, uh, helping them figure out what kind of product to build, all of those things. And that's the role of an investor that he had envisioned for himself. Many of those things are true, but some things have changed. One of the big things that have changed is the companies that go IPO. Uh, there was a point when 50, 70% of these companies used to go IPO, and that was the exit, and that was the liquidity opportunity for some of these private companies. But now, very few companies go IPO. Like 80 to 90% of these companies get acquired along the way. And weirdly, 80% of the companies that get acquired for under $200 million. So they may not even generate the right kind of economics for venture capital funds if companies get acquired for very early in the ecosystem. So that's the situation today. So now you have to look at where in the venture asset class do you fit? Where do you want to focus on? Do you want to focus more on the later stages where we have a lot of unicorns, like 400, 500 companies that just don't go IPO? Instead, they just stay private because there's a lot of the public market capital is now available in the private market. So the companies stay private longer and longer. And at the earlier stages, what used to be Series A, the reason why it was called A is that it was the first round of funding, but it's no longer the first round of funding. It's often the fourth or fifth round of funding. There's a
Right.
pre-seed stage, there's a seed stage, there's a seed plus stage, there's a pre-A stage, and I've heard of avocado stage and mango stage, and I have no idea what those things mean. The nomenclature keeps changing, which means that the earlier stages are stretched out. So it used to take 7 or 8 years to go IPO from beginning to end. Now it takes way longer. Like Airbnb and Uber and others have waited for many, many years before they go IPO.
Right, right. Yeah. It's interesting. I like this topic, and I know we dove right into it there. So sorry if I caught you off guard at the beginning. You're like, oh, usually we go through the introduction phase, but I just wanted to dive into this topic because it was so interesting to me. And I think you hit on something there that's so important for, I think which is our typical listener of this show, right? Which is, probably early stage founders, people who are in maybe a fintech startup or some other form of startup, or broadly more the ecosystem. I think you hit on why early stage startup teams should really care about this move from public to private. Because you mentioned like about 80% of companies will be acquired by another company. And then many of those companies will be private companies, because most companies are private companies. And they may be acquired for under 200 million, but the mindset needs to be there that like we may never go public, right? And a lot of the capital that's coming in is coming in from private investors, obviously. So we should probably change the way we think about this process, right? And think about who we're courting along the way.
Yeah, this is the statistics on this is not easily available. The
Sure.
the success rates of companies going from one stage to the other, how many of them graduate from the pre-seed stage to the seed stage to Series A, B, C, that it's a black box. And it's even worse when you look at venture capital funds. A lot of that information is just not available to anybody, except for the investors who are in the fund, limited partners of the fund. So, because of all of this lack of information, there's a massive information gap, and it's really hard to understand how this asset class works. Correlation Ventures published some information, which is kind of the most referred chart and description in this. They showed that over 10 years, when they captured information about more than 20,000 companies that got funded, 65% of them returned less than the money they took in. So they didn't return the capital they took in, the startups that
Right.
accepted funding from venture capital investors. Another 25% of them returned 1x to 5x, which might sound like a good outcome, but not from a venture perspective, because the goal is to hit 10x or higher. The percentage of companies that hit more than 10x or higher, do you want to guess what the percentage is?
Oh, it's got to be less than 1%, I would assume.
The percentage of companies that hit more than 50x is like 0.4x, and
Yeah.
4% of the companies hit more than 10x or not.
Oh, wow. So it's
10x,
okay. So
20x,
I'm thinking a little lower. Okay. Yeah. That's interesting.
which means that if you invest in all the startups that raise funding, you have a 4% chance of hitting 10x returns. And no one has access to all the startups. So now you have to think about some of the best VC firms probably hit 2%, 2.5% success. So it's a the way to look at it is the power lock dynamics plays very strongly in this asset class. And the human brain is wired to think more for the normal curve. Like you look for the average, and then a plus or minus a little bit standard deviation. You hope to capture a big chunk of the outcomes. That's not the case in venture capital. So that's why it throws people off when they start looking at the venture capital asset class.
That's interesting. It's funny that I think, you know, many people think, VCs invest and they just, everything is, going off the charts, right? And they look at some of these big successes, but you're right. It's like a lot of them are losses. And I know we talk about that all the time in this space, that, most companies don't make it. Most companies don't go to zero, right? They like you said, they're acquired for maybe pennies on the dollar, maybe 50% what it was invested and so forth. And you see that acqui-hire and then it rolls forward and then something else comes out of it. So it's not a complete and total loss, but you're right. That 10x is there not only because that's a goal and you're taking very high risk when you're investing in a company at such an early stage, but that 10x is the goal because do have to make up for all the potential losses, right? Because it is such a high risk. There's so many swings and misses along the way.
There are. It's actually true that many companies lose money. They don't return capital to the investors. So making direct investments in startups is not for the faint of the heart. It's extremely risky, and it's very difficult to build a portfolio that's profitable. And you need to be able to access a lot of opportunities to be able to pick the ones that you want to invest in. So the 65% that I quoted earlier from Correlation Ventures chart was 65% of the companies do not return the capital they take in.
Yeah, yeah,
So some of them go to zero, and it's quite common.
yeah. Well, that's, like you said, not for the faint of heart. And I know for the average investor listening, they might be a little like a little anxiety on that one. Let's dive into you and your fund and your experience. So you mentioned at the top of the pod, and I mentioned in the intro that you're a seed stage investor. You're focusing on, and what that means, in today's climate, still seed stage is still a very early stage company, right? That may have some traction, but they, certainly aren't, doing multiple millions of dollars a year in revenue in most cases, usually. Uh, what is your high level investment thesis? What are you looking for in a seed stage company? And what are you looking to do kind of more big picture in the portfolio?
Yeah, certainly. I say that I invest in scary, scary early stages that most people don't even want to touch. This is a time when PowerPoint slide decks have typos. Most of the companies I invested in have typos in their PowerPoint slide decks when I made the decision. So I don't look for shiny slide decks and well presented marketing materials. Often they don't really have a full fledged product. Even if they do, they have some early customers. It's not really clear which direction they would go and how they may be able to scale. And in some situations, they just put the team together and they haven't really thought about how to build the business. They are still thinking about the business model. In some situations, it's even earlier where the founders are still at their job and they're thinking about leaving the job to start a company.
Mm.
So I've invested in any of these stages. The What I look for is a very strong mission that drives entrepreneurs. For someone to be able to live through the ups and downs, and this is something that even venture capital investors don't really understand. But the rest of the world, it's very hard to empathize with this when you don't haven't seen someone live through this entrepreneurial journey. The highs are high highs, and the lows are low lows, and that's a roller coaster ride. It's not easy
Mm.
for any human being to build a business, whether it's a small company, coffee shop type of thing. It's not that it's easy to build a coffee shop. It is difficult, but uh, large companies that have they taking huge risk and targeting a very large market, or perhaps even creating a new industry, all of these things are risky. But especially with the kind of companies that I invest in, that have potential for venture scale returns, they're taking huge risks and they're swinging for the fences, but very methodically, not recklessly.
Mm.
That journey is very poorly understood. The roller coaster ride can really take a toll on the founding team. So I want to know that there is a mission behind this, not just having an impact on the economic side. There has to be a reason for them to start this company and live through this for the next 7 8 years or however long it takes. The first few years will be grueling. You might see generate some revenue and some customers will appear. The product might pivot. All of those decisions are tough decisions. It's really hard to know whether the company will be successful or not in the first few years, but you still have to build the foundation. So that's what I look for. That's the number one thing I look for. Does the founder have the mission to stay for the long term? And usually they do when they get really excited about something that they don't know much about, and they are voraciously hungry to learn, and they are not going to stop. Nothing can stop them, and they will continue to try and learn and discover things that other people haven't discovered. Often, this is a contrarian view. Often, people with a lot of expertise in something don't have that ability because they get scared. I call it PTSD of in the business world. It prevents them from taking a fresh perspective. Any idea that pops into their head, they immediately kill it because they know four different ways it might fail, and they don't really pursue that. So if there's an expert listening to this, I would say, move to a slightly adjacent area and think of something that you care about. You're very likely to find something and use your transferable skills to apply to a whole new topic and problem, and then you find a solution in that space. It's going to stick. So that's the number one thing that I look for.
I really like that. I mean, so, the way I understand is that you're looking for somebody who has a founding team that has resiliency kind of baked in it. You're really going to feel that this person is going to be up for the rigors of the journey they're going on, right? Because as you mentioned, like everybody envisions their startup is going to be, I'm going to start this thing. And next thing you know, 2 years from now, we are just like rolling in it. This thing's got like a rocket ship. And the reality is it's probably not. And I say it on this podcast all the time that hockey stick growth often looks like a real hockey stick, this really long, flat shaft that, is doesn't have much growth at all for a long time. And then at the end, if you're really doing a good job, several years in, you see the hockey stick that spike up at the end of it, and then you're off to the races. And so having somebody who has that kind of mental and emotional toughness, if you will, for that is really good. And I also liked what you said about the mission, like being convinced that this mission's important, that the thing you're trying to do for people or for companies, if you're a B2B, is something that needs to happen, right? That it's an undeniable trend and that you want to be a part of it and so forth. And you do recognize that you may have to take some detours along the way. You may have to change your methodology and, and pivot. A pivot, by the way, doesn't mean you change the business entirely, right? A lot of times people think about pivoting as like, oh yeah, we're just going to throw everything out the window and try something different. It's like, no, you're turning a little bit, right, with what you've learned. You may have learned something new about the customer. You may have learned something new about the solution or about delivering that solution. So that's really, really interesting advice.
Let's take the example of Rocket Dollar. Like Henry,
Sure.
he's building something. Nothing like this exists. There's
Right.
trillions of dollars out there invested in the public market through 401k and IRA funds. But what Rocket Dollar is building is a small, tiny portion of that market. Even if they get like 0.001% of the market, they're going to be wildly successful. And by the way, they're going to create a whole new segment that was previously inaccessible. What usually happens in these type of situations, and this is what Rocket Dollar facilitates, is people who are wealthy find ways to get a solution. They will do it. There are enough resources out there, but not for the everyday American. People who don't have access, who don't know how to orchestrate all this, they are disadvantaged. But now when you have access through your 401k to invest in real estate and other asset classes, what do? You invest in your local businesses instead of buying stocks and bonds of public companies. You don't even know who they are, and you probably don't know whether you will make money or not. And it's very clear now that the public markets are in chaotic situation. The people who will truly benefit from Rocket Dollar solutions are people who are immigrants, minorities, and people who are in the working class, and they don't have a lot of wealth, but they are in the middle class, in the lower middle class, and middle class, and those are the people that will actively participate in supporting the local economy, and they can do that through their 401k, which was previously not possible. And they are not doing it out of just charity, but it is actually going to generate great returns. And when you have great insight into your own local market, you know how to make those investments, and other people don't have that edge. That's the advantage, and all that advantage is going to waste when you don't have the ability to invest.
Well, and I love it. If we're talking about Rocket Dollar specifically, I love the fact that, like you said, it's bringing a solution that was previously used by an upper class, if you will, or at the higher level, high net worth individuals, ultra high net worth individuals. Henry and I talked about Mitt Romney and Peter Thiel using these types of, most famously using these types of IRAs where they have $100+ million in their IRA because they're investing in private companies. But if you're an average investor, most of your wealth is tied up in your IRA or your 401k, as you mentioned, right? These tax deferred accounts. Most people aren't sitting on hundreds of thousands of dollars of easily accessible, investable cash to invest in a local restaurant or some other type of business, right? But if you think about where they might have an edge, as you mentioned, what businesses are doing really well in your neighborhood. You know where the best real estate is. You know where there should be a restaurant that there isn't a restaurant, right? For example. And so having the ability to invest in those things and use retirement dollars is a really smart idea.
Yeah, so this example is highlights what Henry is all about. He's very mission driven, him and the rest of his team. They are passionate about solving the problem, and it will really make a difference. It'll perhaps even create a whole new industry. And he is not going to stop. And he has the skills. He has spent some time in this area, but it's not like he's building this fifth company. Or even the world hasn't seen a few companies in this space. He's pretty much building he's pioneering in this space. So
Right.
Those are the kind of entrepreneurs that I like to work with.
It's awesome. So, what is your process for discovering deals, right? Deal flow is a huge, important factor in the success of any fund. So, what's the process for you to discover people like Henry?
There are The way I like to think about deal flow is, what can I do to nurture various avenues so that uh, I can allow myself to be present in different places so entrepreneurs can come to me. That's the way I think about it. And I look at it like a garden. I I plant some trees, I plant some shrubs, and I water the roots, and I wait. I wait for a time when these plants will grow. Initial some time it might take, roots are growing and you don't really see anything outside. Then eventually the plants come up and the branches come out, and one day beautiful flowers come out and they will bear fruit. That's my deal flow. If I try to force that today to get the deal flow, I can try to get a few fruits and flowers, but the better way to do is if I can build my own garden. And the way I do it is I surround myself with people that I admire, and they become my ambassadors, and some of them are my advisors and my mentors. And I try to build tentacles over a period of time, and I've done this over 20 years. And that garden is now beginning to bear fruit. And I think it's still in the early stages. I haven't hit the peak yet, but over the next 15, 20 years, I will see this garden bear fruit. And the network that I've built over the period of time is going to help me. A lot of my peers are in that network, people I used to work with. A lot of the entrepreneurs that I helped along the way, they are in that network. A lot of my investors, limited partners, are in that garden, and they are all helping me. So I don't really go out chasing. Often entrepreneurs come to me through this network, but I'm always open to ideas from anywhere. It doesn't have to be someone that is extremely well connected. It takes very little effort to find these people who can get to me. So it is good entrepreneurs come from anywhere. I like to believe that we investors like me need to meet entrepreneurs where they are, and I make an effort to do that. So I've invested in 12 companies. They are all over the country in the US. They're in New York, Atlanta, Boston, Austin, Cincinnati, in Minnesota, Seattle, and of course a few in the Silicon Valley as well. I cannot possibly get to all these cities just by me. Uh, the reason why it works is because I have that garden.
I like that approach, and it is really interesting, right? I mean, the most successful VCs that I've ever seen are doing exactly what you're talking about. They cultivated a really good network. They're active. They're out there. They're meeting. They're interacting with entrepreneurs and the ecosystem frequently. But also, as you mentioned, and I love that you brought this up, you're not limiting yourself to geographical proximity to where you are, right? Because the reality is, look, we're in 2020 now, and you and I are talking, and we're a couple thousand miles away from each other, real time with high quality microphones, right? Like we also have cameras. We have the ability to see each other and have a vibrant conversation without having to be in the same room together. And if you were to just limit yourself to investing only in your backyard, you're probably doing yourself and your investors a disservice.
Yeah, I've always believed that many venture capital investors invest only in their backyard. I have even seen contracts with CEOs, their employment contract, where they say that the CEO's home and nor the headquarters of the company can be more than 25 miles away from some zip code in Palo Alto. Like, that's how adamant they are about their geography. They do not want to go even to Sacramento, which is only 2 hours away from here. So this is how it has operated, which means that entrepreneurs, wherever they are, they needed to move. And you can also make the argument that, because Mark Zuckerberg moved from Boston to Silicon Valley, Facebook became successful. If he had stayed in Boston, who knows what could have happened. I understand that there's an argument there. The ecosystem in the Silicon Valley is very strong. There are a lot of benefits to being in the Silicon Valley, but entrepreneurship is far more democratized and distributed. than just forcing people to come to Silicon Valley. If we can meet them where they are in their own home ground, I think there are many advantages that we can uh, give the entrepreneur in their home ground. Then they can build businesses there. So that's what I believe in, and I've always believed in that. So it's not new to me that I have to do this because of the COVID and the lockdown situation now. But it's still very difficult, I have to admit, when I need to make an investment without ever meeting an entrepreneur. That is still a challenge.
Yeah, I can imagine. I can imagine. Well, I mean, once things come back, I mean, flights aren't that expensive. You can fly and meet people, but what you just said though, I think it supports part of that kind of that investment thesis you talked about look at that, the emotional toll that a startup or any, starting any business, early stage business endeavor takes upon a person is really substantial, and forcing that person to do one of the other most stressful things you could do in your life, which is move, right? Like they always say, like the most stressful things in your life, job change, getting married, having a child, and moving. Well, many entrepreneurs are married with families, so if all of a sudden I had to uproot my family who, with two kids who are in school and say, "Hey, we've got to go to Silicon Valley." Why? Well, because that's where my investor wants to be. It's not going to destroy the family necessarily, but it's definitely going to amp up the stress level.
Yeah.
Right. So letting a person be in the community that they were in, where the inspiration for the idea, where their initial employees came from and founding team came from, there's at least some advantages to it, specifically especially for seed stage investing.
Oh, absolutely. That's a huge advantage. When you're in your home ground, it's always better to play in your home stadium with your home crowd cheering you, with the ecosystem
Right.
around you supporting you in many different ways, not just business but home as well.
Well, and being here in Austin, Texas, I could tell you that there's a lot of the exodus that we see coming out of more expensive places such as Silicon Valley to a still expensive but less expensive place like Austin, Texas. There's a reason for it, right? People are looking for a higher quality of life. It's no longer challenging to get developers or other high quality talented people to come to a place like Austin, Texas. They're like, "Oh yeah, Austin's cool, it's hip, it's got a vibrant ecosystem. I can go there, and even if that thing doesn't work out, I know there's other places for me to go and get a job and work and so forth." So in the 10 years almost that I've lived here, I've seen that the startup ecosystem grow and become more and more vibrant. So it becomes, I think that's possible in other parts of the country as well.
Absolutely. It would be great if we can replicate the success of Silicon Valley in other places. But I'm also mindful of the fact, like, I don't want to sound arrogant that everything in Silicon Valley is great and this is the way to do things and the rest of the world needs to copy. That's not true at all. I think entrepreneurship exists in various parts of the world in its own form, what works for that area. And investors need to adjust to what works for that region and make it work for the entrepreneur. It's an honor to have the opportunity to work with an entrepreneur, especially at the earliest stages. The contributions that I make truly shapes the way the entrepreneurs think, and it's so heartwarming and fulfilling to do that. And the relationship that I form with the entrepreneurs, it's a lifelong relationship. It lasts for many years, and I want to be able to uh, enjoy that. And the way to do that is by meeting entrepreneurs where they are.
That's great. That's great. I loved it. So you recently launched a podcast, and that's actually how you and I got together, right? Andrea Kalman's put the two of us together, like, "Hey, Gopi's doing a cool podcast. I thought of you. You guys should hang out." So we did, and it's kind of really cool. So the podcast is called Sure Shot Entrepreneur. It's off to a fantastic start. You've got a lot of episodes recorded in the can, queued up to go and be distributed and so forth. I've listened to some. I love it. What are your goals for the show? What was kind of the wouldn't mind if you share with the audience, what was your inspiration for creating the show?
Absolutely. I'm so happy that we got connected. Now, you have so much experience in this podcast, and I'm a beginner level candidate here. I'm learning by doing things. The the podcast is called The Sure Shot Entrepreneur. The website is podcast.sure.ventures. Now have, I think, 7 or 8 episodes so far. I'm expecting to publish one episode about 25 minutes long each every week. The guests that I will interview are venture capital investors who invest at the early stages, pre seed, seed stage, and Series A stages. And these are people, many of them I've worked with, some of them are new to me as well, but I have a lot of respect for every single guest that I bring on board. And the reason why I started the podcast is that I want to level the playing field for entrepreneurs everywhere. Entrepreneurs who have network, who know people, have an advantage. These entrepreneurs usually come from privileged backgrounds. So, what does that mean? It means that people who do not come from that privileged background are at a disadvantage. And across the board, entrepreneurs we meet, they always talk about how frustrating it is to understand how venture capital investors think, what is the process, and your questions earlier as well. The first question was like, so how do you make decisions? And that is a very normal thing, but it's a black box when it comes to venture capital. You and the weird thing is some of the best VCs, they don't really do a lot of marketing. They don't talk about their successes and their processes openly. And it's not that all the VCs that talk are not successful VCs, but there are many unsuccessful VCs that do a lot of brouhaha, but you don't want to follow them. But in the absence of any information, there's a lot of misinformation that misleads you. So that's the frustration that I see with entrepreneurs. And I want to be able to level the playing field so that entrepreneurs coming from anywhere can listen to ideas, stories about how people make decisions, pet peeves, misconceptions, and the thrills and disappointments, all of those things in the voice of people who make decisions. And
I
that's
love
not
it.
available today. There are a lot of other podcasts that talk about famous VCs, but I want to get to this niche where entrepreneurs who are interested in finding early believers for their business, especially when one of the early believers in the journey of an entrepreneur is the venture capital investors. When the entrepreneur has ambitious ideas, it is important to surround themselves with a few early believers, and venture capital investors are among them. That's what I want to provide. And hopefully, by uh, creating a repository of knowledge after interviewing many guests, I want to be able to share that knowledge with the world so entrepreneurs anywhere in the world can benefit from learning from the wisdom of all these people.
That's really fantastic. It kind of it feels two goals, right? I mean, there is that, I think, as you're describing this giving back, this wanting to rewater the garden, if you will, to kind of continue your garden analogy for the network and so forth, to like, you know, make sure that you're not just taking, that you're actually contributing and putting good stuff out into the world. So that's great. But there, I would imagine there's a benefit as well. At some point in time, you will see deal flow from this because you're raising your profile and your network's profile, but also you're making yourself more accessible. And I think that is such an important thing. And I completely agree with you. There is a huge segment of the population that unfortunately we may never hear from because they never got the confidence, they never got the knowledge that other folks just kind of grow up having, right? If you are growing up in Silicon Valley, as an example, and you're in a privileged background, or your mom, your dad worked for a startup, you're kind of growing up in it, and you know, right? If you went to an Ivy League school, you understand relatively easily how to navigate the network and get in front of the right folks to get to secure investment. That's not true for the average American. Kind of going back to what we were talking about with Rocket Dollar, right? The average American's never made a private investment in a company. So this, what you're doing is a really good thing. I love it.
Yeah, Ivy League and pedigree don't really do anything to me. But sadly, it is actually not true that if you go to an Ivy League school, no, all your problems are solved. I
You're right.
see so many entrepreneurs. In fact, many of the people who go to these kind of schools, they're already successful, and it's really hard for them to take risks because they are now worried about failure. And they are actually well positioned to start a company, but they struggle because they don't know how to get the first few steps going and how to surround themselves with the right kind of people. So whether Ivy League or not, I think the problem is pervasive, and this is the uh, this. My hope is that when the podcast becomes widely popular, I'm not hoping to turn this into a media company, but I'm not expecting that. But I'm hoping that it will reach the few entrepreneurs who can really listen to this and learn and benefit. And like you said, there are a few objectives here. The number one objective is I want to be able to provide knowledge and insight and insider information to entrepreneurs. That's the absolute number one objective. And along the way, I want to show some of these venture capital investors the best side of them. Most of them don't do a lot of good marketing. So I want to be able to show them and show their words to the world. And of course, the third thing is it's a great opportunity for me to stay connected with the people I care about, I like working
Sure.
with. It's a team sport, and this is my team.
That's wonderful. That's awesome. So what has been like one of the biggest surprises so far, positive or negative? Is it some things like, you're getting into this and it's, oh, wow, I didn't expect that, or that's a curveball, or that type of stuff?
The 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 biggest surprise, both more difficult thing and the positive thing, is the interviewing process. I'm still nervous. I'm not interviewing is a great skill to have. It's when I look at people like Terry Gross and others, and
Mm,
they make it sound so natural, and they get into topics. They can talk to anybody. They can talk to a rock star, politician, and whoever, drug addict and criminals and ex-criminals. They can get stories out of them, and they really connect. And what I really remember, the one phrase that I remember and that I use that as my guiding post is, people want to share things, they are eager to share, but they are reluctant to share because they worry about their message being misinterpreted. That's why that they hold back and they don't want to share. I have a lot of symptoms of dyslexia. I don't really read a lot of books and long form articles, and I I come from that bias. But now hear me here. I don't think books are natural. I don't think newspapers are natural. No other animal on the planet publishes books or sends emails to communicate their message. But all animals talk. And the best nuggets of knowledge that come out in one on one conversations like this. And that is not captured in any other format other than podcasts. And the interviewing style and learning to become a better interviewer is going to help me bring those nuggets of knowledge out into the world. That's I didn't realize how important that skill was. Now, most of my guests are amazing people, so they carry the story by themselves without much effort from me. But I want to get better, and I'm improving slowly. And I really want to get to a place where I'm very good at talking to anyone, so I can bring those stories out. I'm enjoying that, but it's also quite challenging.
that's awesome. And I agree with you. I love Terry Gross, and I am always really impressed with these people who are like, they've been doing it, like you said, for, decades, and, you know, they're just so good at it. You hear some of their guests, like you said, share things that they've never shared before. You're like, I've heard you interviewed on Letterman, or, whatever, Jimmy Fallon's show, whatever. And you didn't talk about this, but here you are with Terry Gross, and you're like getting into it. The thing I've discovered over the years, for me, this is me personally, and I mentioned to you when we had our previous call, that I've been doing podcasting, since '07 off and on. And it's really just liking people is tremendously helpful. Like, people recognize immediately that you're genuinely interested in them, right? And if you just talk to them like a normal person, right, and just, let them know you care and you are actually interested, good stuff will come out, right? Like, I teed off this podcast, so, and we jumped right into the topic, and I could tell, like, might have caught you off guard a little bit there, but over this portion, over the length of this show, things just flowed. All the good stuff came out anyway. So I love it.
Yeah, the art of listening is a skill. It's anybody can learn at any age, and it's an ocean out there to get better and better. And the advantage I have, unfair advantage, is that I'm in the business of venture capital. So I can relate to a lot of my guests much more easily than anybody else. So I want to be able to use that to my strength and uh, engage with audience with my guests, so that the audience can benefit from the stories that they share.
Fantastic. Fantastic. Okay. So now for my favorite part of the show, which is the ask of the listener, your ask of the listener. So I'm not sure if I told you about this, but anybody who presents at the SoFi at South by Southwest event, or anybody who is attends as an attendee, I always tell them, you need to have an ask for the audience. You need to have something you want from people, because you're meeting people, you're at a business event, you're hoping to get something. You're hoping something moves forward for you and your business. And if you're presenting to people, if you're on a podcast like this, or if you're on stage, there's something if we could, let's ask people. So if you could ask the audience or something, what would you ask them to do?
My ask is for the audience to listen to my podcast and share it with entrepreneurs who they think will benefit from uh, hearing the insider stories of venture capital. This is a new podcast, so word of mouth is the best way to get it in the hands of the people that will benefit. I don't have ads in my podcast. I don't plan to generate revenue, not in the short term. Uh, so the way I want to be able to organically grow is through listeners, and listeners that contribute to this journey will I'll be very thankful to them. But in general, my message to entrepreneurs is that we need way more entrepreneurs than we have today. And I think the spirit of entrepreneurship, we all need to contribute to nurture it. And I'm doing my part and go out there and build businesses.
Rock on. I absolutely love it. Well, Gopi, it has been a fantastic pleasure and honor to have you on the show. I've loved our conversation. I don't think this is going to be the last time I'm going to have you on the show. I highly suspect you'll be on the show again. We'll have many more venture capital topics, and I'm also going to want to check in on you to see how the podcast is going. So
thanks
very
man. Much. You're a natural at this. I can see how you're so good at podcasts, and I hope to learn more and more from you.
Awesome. Great. Thanks, sir.
Thank you.
Thank you very much for listening to this episode of the SoFin Podcast. It's always a pleasure to have you here. Please do make sure you send in your questions or suggestions for guests or topics for the show. You can reach me. I'm at Mike Langford pretty much everywhere, or you can send an email, mike@finservmarketing.com. Also, huge thanks to Gopi Rangan for joining me today. It was an absolute pleasure having him on the show. Make sure you check out his podcast, by the way. You go to podcast.sure.ventures and you'll check that out. The Sure Shot Entrepreneur Podcast featuring Gopi is going strong. Really, really good stuff. It's great to have somebody else in the podcast community. Lastly, if you haven't done so already, please do make sure you subscribe to this podcast and give it a like, share it with a friend. Let the world know about this show and the broader FinServ Marketing Podcast Network. We are building a vibrant community here, and the more people that listen, the more people that know about it, the more goodness gets out into the world, okay? Hope you are healthy and safe. Please do make sure you help everybody else stay the same. Wear that mask, keep your distance, get in line when the time comes for that vaccination. And of course, be nice to each other, okay? We'll see you next time on the SoFin Podcast. See ya. Bye.